Baseball season is around the corner. Today's video fits that theme by featuring a partial owner of the Mets, but not with the crack of the bat, rather the crackdown of the SEC. Steve Cohen owns a net worth estimated by Forbes at $14.6 billion, placing him firmly in the top 100 richest billionaires. Safe to say, he is balling. Literally, he co-owns the New York Mets. When not involved in swinging bats, he might swing a golf club at the golf course attached to his $23.1 million Connecticut mansion. That paparazzi-prowling property adds a basketball court, ice skating rink, and a pool. Hopefully, Damien Hurst's iconic tiger shark Cohen bought for $8 million won't revive for a swim. That's the crown jewel of Cohen's shiny $1 billion art collection. Point is, Cohen is living what many consider the American dream. Today, we will discuss the nightmarish reality of how he obtained that money. You can obtain more videos in a much more honest way. Simply click the like button and smash subscribe to help grow the channel for more content. Cohen was a short-term active investor, oftentimes making massive micro trades in mere seconds. As the name implies, active investing is investors actively choosing investments that are likely to outperform projections in the future. The goal is beating the market. Cohen beat the market with the precision of Floyd Mayweather's beating opponents. Cohen's money considerably outnumbered Money Mayweather's. SAC Capital Management LP, Cohen's largest and oldest fund, launched in 1992. It had generated an average annual return to investors of 43.5% after fees. That accomplishment magnifies when considering partners at SAC's peak kept 50% of that fund's gains, along with a 3% annual fee, far more than the 20% and 2% annual fee charged by managers on average. Shortly before the firm's downfall, SAC's trading comprised 2% of overall stock market activity. SAC paid security firms an average of 1 cent for each share it trades, which added up to more than $400 million trading commissions each year, making SAC one of Wall Street's most dominantly lucrative mainstays. Safe to say, Steve Cohen was one of the kings of investing. However, money is made of paper, and any kingdom built on pillars of paper wobbles in the wind. The winds of change that destroyed the Cohen castle down blew in 2013. The castle tumbled from the inside. Insider trading, to be specific. That's a term all of you have likely heard, but may not know exactly what it means. Insider trading is trading public stock or other securities based on information not privy to the public. That's why they get caught. But how? Big Brother catches big shots making bigger mistakes and tattles to the justice system. In Congress, the Senate Committee on Banking, Housing and Affairs and the House Committee on Congress watches all securities and acts according to effectiveness, occasionally choosing to pass new laws and enforce existing ones. The Investment Company Act and Investment Advisors Acts of 190 regulate investment companies such as SAC and financial advisors. The Insider Trading and Securities Fund Enforcement Act of 1988 increased insider trading penalties. However, the Sarbanes-Oxley Act changed the game. The laws mandate insider trading on securities must be reported within 2 business days. The Act created charges for violations, including partaking in schemes to defraud investors connected to any security. SEC handles everything on the insider trading front. It's not okay not to know. Cohen learned that lesson the hardest way. In 2013, SEC charged him with failing to supervise portfolio managers and prevent insider trading. The SEC's Division of Enforcement alleged that Cohen received highly suspicious information that should have caused any reasonable hedge fund manager to investigate the basis for trades made by portfolio managers Matthew Martoma of CR Intrinsic Investors and Michael Steinberg. Cohen ignored the red flags and allowed Martoma and Steinberg to execute the trades. Instead of scrutinizing their conduct, Cohen praised Steinberg for his role in the suspicious trading and rewarded Martoma with a $9 million bonus for his work. Cohen's hedge funds earned profits and avoided loss of more than $275 million as a result of the illegal trades. How large of profits? Well, co-director of the SEC's Division of Enforcement, Andrew Seresny, noted that the firm had agreed to pay for $615 million for alleged insider trading before charges even began. According to the SEC's order instituting administrative proceedings against Cohen, portfolio managers Martoma and Steinberg obtained material non-public information about publicly traded companies in 2008, and they traded on the basis of that information. What information? Well, illegal trading on information in the pharmaceutical industry that became a hard pill for Cohen to swallow. In 2008, SAC had accumulated a $700 million long position in pharmaceutical companies. Elan and Wyeth, which were in joint development of a drug called barpinnuzumab that was hyped to treat mild to moderate Alzheimer's disease. Unfortunately, hype is as far as things got. After a promising phase 1 in clinical trials, a different trial involving 234 patients, including 12 people with mild to moderate Alzheimer's, were treated with the drug. They developed a new buildup of fluid in the brain called vasogenic edema. Simply put, nasty brain swelling that can kill you. But SAC Capital didn't share in the loss. In the week prior, Cohen had not only liquidated SAC Capital's nearly 750 million positions in Elan and Wyeth, but shorted the stocks. Betting against the companies earned Cohen a profit of $276 million. The SEC charged Martoma and his tipper with insider trading in an enforcement action last year, and charged Steinberg with insider trading in a complaint filed earlier this year. In connection with those cases, CR Intrinsic, an affiliate of Cohen's firm SAC Capital Advisors, agreed to pay more than $600 million in the largest ever insider trading settlement. Another Cohen affiliate, Sigma Capital, agreed to pay nearly $14 million to settle insider trading charges. The SEC's investigation found that in his supervisory role, Cohen oversaw trading by Martoma and Steinberg and required them to update him on their stock trading and convey the reasons for their trades. On at least 2 separate occasions in 2008, they provided information to Cohen indicating their potential access to inside information to support their trading. However, Cohen stood by on both occasions instead of ascertaining whether insider trading was taking place. According to the SEC's order, Cohen watched Martoma build a massive long position in the stock of 2 pharmaceutical companies, Elan and Wyeth, based on their joint clinical trial of a drug with the potential to treat Alzheimer's disease. Cohen allowed this despite repeated emails and instant messages to Cohen from other analysts at CR Intrinsic advocating against it. The analysts questioned whether Martoma possessed undisclosed data on the results of the trial. Cohen responded by saying it was tough to know whether Martoma knew something, but that he would follow Martoma's advice because he was closer to it than you. In later exchanges of instant messages, Cohen further remarked that it seems like Matt has a lot of good relationships in this arena. Cohen also was told about a doctor who had provided his portfolio managers with potentially non-public information about the clinical trial, but failed to express any concern about the use of that information. During his email exchanges, Cohen displayed no concern that Martoma might possess non-public information or about his use of such information to inform investment decisions at his firm. Instead, Cohen encouraged Martoma to talk further with a doctor familiar with the clinical trial. The SEC's Enforcement Division alleges that after months of building up the massive position and being bullish on both Elan and Wyeth, Martoma had a 20-minute phone conversation with Cohen on July 20, 2008. According to Cohen, Martoma said that he was no longer comfortable with the Elan investments that CR Intrinsic and SAC held. Despite Martoma's abrupt change in view and red flags that he likely received confidential information about the clinical trials from a tipper, Cohen failed to take prompt action to determine whether an employee under his supervision was violating insider trading laws. Starting the next morning, Cohen oversaw the liquidation of his and Martoma's positions in Elan and Wyeth and the accumulation of a short position instead. According to the SEC's order, Cohen also supervised Steinberg while he was involved in insider trading of Dell Securities in August 2008. After being looped into a highly suspicious email between Steinberg and other firm employees, reflecting the clear possibility that they possessed material non-public information about an upcoming earnings announcement to Dell, Cohen again failed to take prompt action to determine whether Steinberg was engaged in unlawful insider trading. Instead, Cohen liquidated his Dell shares based on the recommendation of Steinberg, who continued short-selling Dell shares in his Sigma Capital portfolio based on the confidential information. Dell's stock price dropped sharply after its August 28 earnings announcement, and funds managed by Cohen's firms profited or avoided losses totaling at least $1.7 million. 3 hours after the earnings announcement, Cohen, in an email that should have been left in the drafts or trash bin, told Steinberg, "Nice job on Dell." The SEC's Division of Enforcement alleged that by engaging in the conduct described in the SEC's order, Cohen failed reasonably to supervise Martoma and Steinberg with a view to preventing their violations of Section 10b of the Exchange Act and Rule 10b-5 thereunder. The administrative proceedings will determine what relief is in the public interest against Cohen, including financial penalties, a supervisory and financial services industry bar, and other relief. The SEC's investigation was conducted by Chief of the SEC Market Abuse Unit Joseph Sansone, SEC policeman Charles Riley, and Daniel Marcus, also a member of the Market Abuse Unit in New York. They were joined by Amelia Cottrell, Matthew Watkins, Justin Smith, Neil Hendelberg, Diego Brucaleri, and James Davino of the New York Regional Office. What were the results? The SEC's order found that Cohen failed to supervise Martoma, who engaged in insider trading in 2008 while employed at CR Intrinsic Investors, an investment advisory firm that was a wholly owned subsidiary of SAC Capital Advisors LLC, an entity founded and controlled by Cohen. The steep consequences of Cohen's failure was essentially getting banned from advising or investing until 2018 and needing to be under the watch of an independent consultant, SEC Examinations. The SEC attacked Cohen's wallet with a strike as equally vicious as this eye poke. SAC Capital paid $1.8 billion in fines from insider trading. That sum remains the largest trading fine ever. The blow wounded wealth, but wasn't lethal. Cohen bounced back in 2019, making an estimated $1.3 billion in his comeback year. He now leads Point72 Asset Management, a $16 billion hedge fund firm. His extreme wealth makes him the 36th wealthiest American according to Forbes. We hope this video ranks among the best parts of your day. If so, please click the like button and subscribe for future videos that may not make you as rich as Cohen, but will enrich your business learning.